Volatility is the up and down movements, and usually actually measured by the standard deviation, which is a measure of how much things move from their typical movement. When you take a look at a day, the typical movement is typically up, but not very much. So anything up or down from zero is pretty much what you're getting as a volatility. And of course, we've been getting a lot lately. Well, the biggest driver of volatility is when the markets drop. If the market drops, there are some even simple leverage reasons why that would cause volatility. But following a drop in the market, volatility shoots way up, and then it tends to dampen down afterwards. Of course, in the 1930s, we had such a sustained drop in the market, actually two big falls at the beginning of the 30s, starting in 1929, and then the end of the 30s, another one. And so it was our worst decade ever, and that caused the volatility to run really high. And it continued high even in World War II until it was clear we were going to win that war. Now, we've seen those rises in volatility. The decade after 2000 has been a very, it's also gone through two crises already. It started out with a tech bubble collapse and the stock market collapse and a big recession at the beginning of the 2000s. And then we had the financial crisis, and in both those cases, volatility spiked upward. We're seeing I think, a more short-lived spike right now in volatility, which is associated with so much uncertainty. It's really a follow-on from the financial crisis, though. If there's a lot of news and action and a lot of things going on, these are the sort of things that, of course, the market is trying to assess a valuation for everything that's going on. And for example, in the last few months, over and over again, we've been hearing things about the European debt crises. And not only the European debt crises, but the whole kind of global debt crises. And these are really scary to the market. The market has to assess how bad the situation is. There's lots of differences of opinion, how bad the situation is, and questions about who will get bailed out and which ways. So this kind of uncertainty is what drives volatility. Of course, it's tough on the people, but it has some benefits because the high volatility actually knocks out a lot of marginal firms. And yes, it is harder to start up new firms, but it reshifts capital around into better uses. We've become the whole United States, for example, becomes much more savings-oriented than we had in the past. Now, that has immediate problems in the sense that we don't consume enough to stimulate the world economy as we did before. But it's a self-correcting type of thing, which brings us back into more normal patterns because we really should be saving and investing more as a country. And so these sort of crises actually, I think, have well, of course, it's been called creative destruction of the economy, but they set up the creative destruction so we can restructure and reformulate and become more efficient again. And fortunately, our own economy is adaptable in many ways to this creative destruction.